Welcome to The Explainer. So today, we're tackling a massive topic, building wealth. And look, I want to set the record straight right from the jump. You absolutely do not need to be a financial genius to do this. Seriously, no finance degree required, and you definitely don't need to be glued to 5 different computer screens crunching numbers all day.
Because think about it, what if successful investing didn't actually require predicting the future? I mean, we've all felt that anxiety, right? That nagging fear of a market crash, the sheer stress of trying to time everything perfectly so you buy low and sell high. Honestly, it's what keeps so many of us from even starting. But what if I told you that the absolute best strategy out there actually ignores all of that noise?
Okay, let's dive into this. Picture this. On one side, you've got the chaotic, totally stress-inducing life of the emotional investor. You know the type. They're constantly swept up by the market's waves, chasing the latest trends, panicking when things dip. But then, on the other side, we have the calm, steady consistency of dollar-cost averaging. This is a method that practically removes the guesswork and the emotion from your financial decisions.
So here's our roadmap for this explainer. First, the emotional investing trap. Second, the magic of DCA. Third, exactly where to invest your money. Fourth, building your personal DCA plan. And finally, the path to long-term wealth. Let's get right into it.
Section 1. The emotional investing trap. Why brilliance just isn't enough. You see, our brains are literally hardwired to protect us from danger. Thousands of years ago, that evolutionary instinct kept us alive in the wild. But in financial markets, that exact same instinct to run away from danger actually sabotages us. Let's look at investor A, super intelligent but deeply emotional. They're constantly tweaking their strategy, chasing what's hot and panicking the second the market dips. Then look at investor B. They just have average financial knowledge, but they invest consistently and completely ignore the short-term noise. And guess what? History and data show us that investor B absolutely crushes it over time. Why? Because in investing, your behavior matters far, far more than raw intelligence. And this brilliantly illustrates why. That evolutionary instinct we just talked about, it creates some major emotional traps. Fear makes us sell way too early or panic during a crash. Greed makes us chase those quick, flashy profits. Then there's FOMO, the fear of missing out, where we jump in just because everyone on our social media feed seems to be getting rich overnight. And of course, herd mentality, where we just assume the crowd must know what they're doing. Researchers actually call this loss aversion. Basically, a temporary market dip feels like a permanent, life-ending disaster. It hurts so much to see those numbers drop that people panic and sell. And by doing that, they literally turn a temporary decline into a permanent, locked-in loss.
Ouch. Section 2. The magic of DCA. Consistency beats perfection.
So the big question, how do we mechanically avoid those psychological traps? Well, imagine a tomato seller in a Legos market. She spends exactly 20,000 naira every single week on tomatoes for her business, period. When there's heavy rain and supply drops, prices skyrocket, right? So her fixed 20,000 naira buys her fewer baskets. But when the weather is great and supply is booming, prices drop. Now, that exact same 20,000 naira buys her a ton more baskets. Almost like magic. Over time, her average cost balances out, all without her ever needing to become a meteorologist and predict the weather. And that right there is the core essence of dollar-cost averaging, investing a fixed amount at regular intervals. Let's put some numbers to this. With Ada's simple 3-month investment journey, she's committing 20,000 naira a month. Month 1, the price is 2,000 naira, so she grabs 10 units. Simple enough. But in month 2, the market takes a hit. Fear is everywhere, and the price plummets to 1,000 naira. But because she's sticking to her consistent 20,000 naira, she naturally scoops up 20 units. She's literally buying the dip automatically, without even thinking about it. Then, month 3 rolls around, the market goes crazy, and the price spikes to 4,000 naira. Her fixed investment means she only buys 5 units, which brilliantly prevents her from overbuying right at the top.
Now, what's really interesting about this slide is Ada's final average. Think about it. The price spiked all the way up to 4,000 naira in month 3. But her average cost per unit across the entire period stayed incredibly low, just 1,714 naira. She put in a total of 60,000 naira and walked away with 35 units. Her fixed strategy essentially forced her to buy more when things were dirt cheap, and she didn't have to stress over timing the market once.
Moving right along to Section 3. Where to invest your money. Stocks, funds, and crypto.
Okay, so the math makes sense, but where do we actually apply it? Let's talk about exchange-traded funds, or ETFs. Honestly, the easiest way to think about an ETF is like a fruit basket. If you spend all your money on just mangoes, and we have a terrible mango season, well, your entire investment is ruined. But instead, what if you buy a basket filled with mangoes, apples, and oranges? An ETF does exactly that, but with companies. It's a basket of different investments. If one company in your basket tanks, the others might still be doing great, which wonderfully spreads out your risk.
And then, of course, we have cryptocurrency and the blockchain. Think of the blockchain as this incredibly secure digital notebook that's shared globally, which makes it highly transparent and nearly impossible to alter. Now look, we all know crypto is famous for those wild, heart-stopping price swings. It is high risk, for sure, but guess what? That is exactly why dollar-cost averaging is the absolute perfect strategy for it. DCA smooths out those volatile emotional spikes, letting you build up your position over time without the total nightmare of trying to perfectly time the crypto market.
Section 4. Building your DCA plan, your step-by-step guide.
Let's move to and see how this builds into an actual system you can use. Step 1. Define your SMART financial goals, meaning they need to be specific, measurable, and time-bound. Step 2. Build an emergency fund. Do not skip that. Step 3. Pick a consistent investment amount. And hey, it doesn't matter how small it is to start. Step 4. Choose your assets, like that ETF fruit basket we just talked about. And finally, Step 5, and this is the absolute game changer. Automate your investments. Seriously, setting up an automatic bank transfer completely takes willpower out of the equation. You set it, you forget it, and you let it grow.
But listen up, because there is a very strict golden rule here. You must only invest what you can afford to leave invested. Never, ever use money that's meant for rent or food or school fees. Having that emergency fund from Step 2, that's your umbrella. It protects your investments. It makes sure that if life throws you a curveball, like a sudden medical bill, you aren't forced to sell your assets at a loss during a market panic just because you desperately need the cash.
Which brings us to Section 5, the path to wealth, time, and discipline.
Let's zoom out for a second and look at the big picture. Simply saving money, like keeping cash stuffed under your mattress, actually means you're slowly losing purchasing power thanks to inflation. The cost of things go up, but your pile of cash stays exactly the same. Investing, on the other hand, puts your money to work. It gives it the chance to grow faster than inflation over time. Bottom line, saving protects your today, but investing, that's what builds your tomorrow. And time is what creates that massive wealth gap. Imagine Amina starts investing at age 25, but Chinedu decides to hold off until he's 35. Even if they end up investing the exact same amount of money every month, Amina's wealth is going to completely dwarf Chinedu's. It's kind of like a bamboo tree, right? It grows its roots invisibly underground for years, and then bam, it shoots up into the sky. That's the sheer power of compounding. Time is a far, far greater asset than the actual size of your initial investment.
Before we wrap this up, let's rapidly debunk a few common pitfalls so you don't fall into them. First off, never pause your DCA strategy during a market crash. Remember, market downturns are usually the absolute best buying opportunities. It means everything is on sale. Second, stop checking prices every hour. Just stop. It only feeds your anxiety. Third, please don't expect to get rich overnight. And finally, whatever you do, do not chase social media hype or some unverified meme trend. Stick to your boring, beautiful, highly effective automated plan.
So, the crucial point is really summed up in this one classic saying: time in the market beats timing the market. At the end of the day, consistency is absolutely everything. Your behavior, your patience, and your daily discipline are going to take you so much further than trying to outsmart the market and predict every little dip and spike.
Because wealth isn't built in some dramatic movie-style montage moment. It's built in the background, over years of steady, automated habits. Which really leaves us with one final important question. 10 years from right now, will you be looking back at a massive fortune built by simple automation? Or will you still be sitting there waiting for the perfect time to start? Thanks for hanging out with me for this explainer, and I'll chat you next time.